In this video, you are not just going to watch another chart breakdown. You are going to understand how smart money builds a trade step by step. I'll show you how a market that looks bullish at first slowly transitions into a high probability sell setup using structure, point of interest, inducement and liquidity. By the end of this video, you will know why price moved, where professionals entered, and how you can frame the same logic in your own trading. So make sure you watch this carefully. Let's start from the left side of the chart. Market structure from left, bullish phase. If we look at the left side of the chart, the first thing we notice is that market structure is bullish. Price is making higher highs, price is making higher lows. Buyers are clearly in control. This bullish structure tells us only one thing. At this stage, the market is delivering liquidity to the upside, and this is very important because smart money does not chase price. Smart money uses bullish moves to prepare future positions. So while retail traders see strength, institutions see opportunity. Now, as price continues, we reach a point where this bullish structure fails. We get a break of structure from the left side. This is critical. But break of structure tells us that buyers are no longer in full control. It does not immediately mean sell. It means attention. Something is changing. And whenever structure breaks, we stop thinking emotionally and start thinking logically. Point of interest, what it is and why it matters. After the break of structure, price creates a zone above. This is what we call a point of interest. But let's be very clear, a point of interest is not just a rectangle. It is not a random zone. A point of interest is an area where smart money previously interacted with price. It is a zone where orders were placed, positions were built, and future reactions are expected. Why we marked this point of interest here. Now, this is the most important part. Why did we draw the point of interest right here? The answer is simple, because after price reacted to this area, we see a change of trend on the lower time frame. This is the key logic. On the higher time frame, everything still looks strong, but when we zoom into the lower time frame, we see something completely different. Lower time frame change of character. LTF Choch. After price touches the point of interest, the lower time frame shifts from bullish to bearish. This is called a change of character, and this is not random. This tells us that inside this zone, buyers were absorbed and sellers stepped in. This confirms that the point of interest is valid. Without lower time frame confirmation, a zone is just a guess. With confirmation, it becomes a professional trading location. Inducement, what it is and why it exists. Now, after the point of interest is formed, the market does something very interesting. Instead of dropping immediately, price starts moving in a way that invites traders in. This is called inducement. Inducement is a move designed to trap late buyers, create liquidity, build fuel for the real move. Price moves up slowly. It looks safe. It looks bullish again. But this move is not continuation. It is preparation. Smart money uses inducement to force traders into the wrong side of the market. Sell-side liquidity, what it is and why it's the target. Now, below price, we can clearly identify sell-side liquidity. Sell-side liquidity represents stop losses of buyers, panic exits, forced liquidation zones. This liquidity exists because retail traders bought the highs and placed their stops below the lows. Smart money needs this liquidity. That is why price must move down. Liquidity is not optional. It is required. Entry logic, where we enter and why. Now comes execution. We do not enter randomly. We do not chase price. Our entry happens after confirmation on the lower time frame. Once inducement is completed and price shows bearish intent, we enter from the inducement zone. This gives us maximum reward, minimum risk, institutional alignment. Stop loss placement. Logic, not fear. Our stop loss is placed above the previous high, but not just slightly above. We place it in a way that if collects liquidity with a wick, our stop is not taken. Why? Because smart money often sweeps highs with shadows before continuing the real move. Our stop must survive manipulation. Target. Why sell-side liquidity? Our target is clear. We target sell-side liquidity, not because we hope price goes there, but because price is designed to go there. Liquidity is the magnet. Once sell-side liquidity is taken, the objective is complete. Risk management. Before we finish, one important reminder. No setup works without risk management. Fixed risk per trade, no emotional sizing, no revenge trades. Smart money survives because it controls risk first. If you want more videos like this, where we break down real charts, real logic, and real execution models, make sure you follow the channel and watch the next video, because in the next one, we'll go even deeper.